Startup costs. They basically in the first year of business you can claim $5,000 of startup costs. It used to be none. You had to amortize them over 5 years, so they simplified the law a few years ago. Again, a wonderful simplification. Lets you deduct up to $5,000 in year one. The rest of it gets amortized over a 60-month period, 5-year period of amortization of any startup cost. That's why I'll tell employees, look, I got an employee going to open a business of some kind. I'm trying to think of an example offhand, but I'm saying, look, you want income almost immediately. You know, if I'm going to open a consulting business, I want Chris to engage me before I have any equipment. I want him to engage me immediately so the startup ends, because the startup ends when you have income. Some people say, look, I'm studying this for 3, 4, 5 months. This is all startup mode because they've got no income. You want income almost immediately to end that startup period and make all your expenses deductible, other than being set with a 60-month amortization of expenses. So again, that's something you need to talk to your accountant to try to minimize the startup period. I've seen some business go on for 2 years in startup mode where they're doing research and development or something, and heck no, you want income quick. Had a client that did this with their IT business where they did research and they were building some kind of software model or something. I said, no, you want to go out and do some IT consulting. First day you're there to have income to kill the startup period. So you're actually generating income. The startup period is ended. Otherwise, all your expenses, your supplies, everything like that gets spread out over 60 months when you start business. So again, you want to stay away from that longer startup period as much as possible. Advertising, marketing, a lot of people, you come in and I'll do your taxes. I know someone who's a big contributor. Phil contributes a lot to charity. He's a big contributor. Isn't that right, Phil? Mm-hmm. Okay, that's what I thought. So, but what we'll tell him to do is to primarily, if he's contributing to some charity, we don't want it to be a contribution because there are limits on contribution. We want it to be advertising. So you want it to be his logo on whatever he does. I support the Clayton State Foundation golf tournament, but my logo is on everything that I generate for them. Maybe stamped on the food that they're selling too that I'm putting in. So again, my logo's there, so it's all advertising and promotion to me. Well, I've got a big banner up there that says food provided by the wonderful Loggins Associates. So therefore it becomes advertising, not a donation. So you get a much better kick out of the advertising, because if you're in a small business, you do a contribution of $1,000. Well, if it's a true contribution, it's deductible, after Social Security tax. So you got to pay $150 of Social Security tax on that $1,000 before you take the deduction on your individual return. So again, you want this stuff to be advertising. Goodwill cost spread out over 15 years. So if you buy a business for someone, you're going to spread whatever you're paying them for the business itself over 15 years. That's why you want to try to allocate as much as you can to equipment, hardware that you can write off over 4 or 5 years. Deductions for education. If you do a program for all your employees, you can pay up to $5,000 of their education cost for basically for whatever they're studying. So that works. But again, you've got to include all employees. If you, however, if I send Josh to a specific class that's going to help the business, that's not education. That's training for the business, and therefore is fully deductible, excluded from the education limitation. Now, this limitation also applies, of course, under a separate program to daycare. It used to be back probably when they put the $5,000 limit in the law, you could get daycare for a kid for $5,000. Nowadays, it's minimum of $100 a week. I mean, maybe $150 a week. So you're well above that. So you have problems with that limitation now. But again, that would be something the employer could pay and make it deductible out of your pay. Therefore, you're not paying some payroll taxes and some other stuff on it. Certainly saving you the employer's money. Quite commonly, this kind of thing, although the education's not, but you use a cafeteria plan to generate more benefits and that kind of thing. Isn't that what y'all do? Y'all set up the cafeteria plans. Here's my ADP rep. Years ago they sent a guy out as ADP rep, and they wised up on now sending cute girls out as ADP reps. I mean, they wised up. They sell much more there. But anyway, and the ADP has programs there that do all that kind of stuff. ADP has programs that do unemployment compensation as you go, rather than have to pay it up front. There are a lot of benefits you can get from using either what's called a PEO, Professional Employer Organization, which ADP has one of those, or something like that to minimize, and they may be able to minimize your health insurance. You go in and you're in a small pool, You may be paying higher health insurance. You go to a PEO of some kind because of their large pool of employees, they may be able to actually save you money rather than costing you money. Aren't I right? There you go.